It is episode number 80, September 23rd, 2020, 39.6 Facebook Live Finance Show. How do I make money with whole life insurance? Sorry for the sounds. This is the 39.6 Facebook Live Finance Show. The show that teaches high earners like yourself how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, how to manage your life expenses like childcare, and even the car you drive. Today's question comes from Raman in the 39.6 Facebook community, 39.6 community, where we have about 550 members now. Please invite your friends. Please share. I don't know if I'm saying your name right. It's R-A-M-I-N, Ramin, maybe. He says, can you please discuss how people make money off their own whole life insurance policies? If you want to have your questions answered, please post them in the Facebook group. I try to get to all the questions. If I haven't gotten to a question and you have posted, please just tag me in the post and I will try to get to it. Okay. So I really like first how he says, how do you make money on your own whole life policy? Because if you've been around or around any of these communities about physician finance, you'll often see people asking about whole life policies because it's the number one thing that people get sold by financial advisors to make money for a financial advisor. I have really upset a number of people who've kept on trying to sell me whole life insurance policies. But ultimately, these are products that are mostly designed to be sold, not purchased. Okay. When you talk to a life insurance salesman, ask them how they get paid and ask how their commissions are. They obviously are getting paid for their work. Everybody needs to get paid. And life insurance policies in general, they often pay similar commission structures, at least from what I understand, regardless of what kind of policy it is. And so they'll say, well, the commission structure is the same. I get paid the same commission. I'm like, there's no way you get paid the same commission selling me a whole life policy as a term life policy, or else you wouldn't be trying so hard to sell me on a whole life policy. They're like, well, it's the same structure, same percentage. It's just that the premiums for the same benefit are like 10 times as much. I mean, it depends on you and what class you fall in and whatnot, but it's many times higher. So the commission is way higher for the salesperson. And they make most of their commission in the very first year. So a lot of people get wind of these policies. They're like, why am I making all these payments? What am I actually getting for this? And then they decide to quit. But by the time they decide to quit, they have already put in so much into it that the salesperson has already made most of their commission. Somebody told me once they get like 80% of the premiums from the first year all go toward the commission. Like, that's incredible. So they're really motivated just to get you to buy a policy and hold on to it for a year. And after that, it just doesn't really matter much to them. They may even try to sell you a different new policy to get another commission. And I've heard of people reselling people on different insurance policies, trying to get them into new policies to get them new commissions. So it's very clear how the salesperson makes money, and they can spend that money and make money. Okay. Or they can make the money and they can spend the money, or they can invest it. How do you as an individual with a whole life insurance policy make money? Well, it is an investment, right? Technically, there is a side pot of investment. So when you invest in a permanent life insurance policy, this is a policy that's not a term policy. Term and permanent are opposites. Near and far, big and small. My 3-year-old loves these opposites. Okay. So term and permanent, as opposed to like impermanent. So term lasts until a term ends, and then the policy's done and it has no more benefit. But you could get a convertible policy that you could convert into a permanent policy, but we'll avoid that. A whole life policy is a permanent life insurance policy, so you pay into it and it never expires. It goes on until you die, and you will get paid out when you die, assuming you have kept up with the premiums. If you don't pay the premiums, of course, the policy can term expire and boom, you have no benefit anymore. But if you keep up with the expenses, the premiums, you will get paid out for sure. So that's why the difference is so much higher, because when you're buying a term policy, you're buying, basically you're gambling. You're putting money on and paying for the possibility you might get paid. With a whole life policy, you're paying knowing that you're going to get paid. Okay, so they take your premiums, they invest it, and they plan on paying it back to you. Of course, there is attrition and people back out, but they're taking your money, they're investing it, and they're going to give you this little side pot where they call it cash value. And that side pot of your cash value will grow over time. And that cash value is the amount of cash in this side pot that you can potentially access, for example, with a loan. Or if you were to close the policy out, and this cash value is like what they call the surrender value. If you surrender the policy, you will get that cash back. Oh, that's exciting. You will get cash back. People will sell you, I'm going to sell you a life insurance policy, and you're going to also make money on it. And if you decide to cancel it out, you will still get paid back. Your term policy won't do that for you. Right. But your term policy costs like 10% of the whole life policy. And so you could be investing that other 90% and actually have that money the whole time. Okay. So, but there is this little thing called cash value. So I tried to find an illustration that would actually show you what your cash value is. Now, I went to this website called insure.com, and these numbers are totally not accurate, but it gives you something to look at. So let's pretend you have a $100,000 whole life policy. Now, in year one, you put in $1,200. The cash value, the whole life cash surrender value, is 0 in that first year. Okay? Basically, you have no cash value. If you quit in that first year, boom, it's all commissions, all gone. So it says the whole life annual rate of return is negative 100%. It's all gone. It disappeared. Okay, we're going to avoid this next column next to it. In year two, you put another $1,200 in. And now the cash value is 27%, or sorry, $27. It's still mostly going to commissions. Fantastic. So not until the third year of paying your premium, $1,200, you actually have something to show for it. And the amount you have here, $860, which you've already put in like $3,600 here, and you have almost $900. So about 25% of what you have put in is included in your cash value. So you could get like 25% of your money back. Okay. Put another $1,200 in year four. Oh, wow, look, it's worth $2,300. Okay, so you've put in $4,800 and it's worth $2,300. That's actually almost 50%. Now, this is total garbage because they throw in a rate of return of your investment of 21%. Okay, then your cash value goes up to $3,700 the next year, and they put in another 12% return. Now it's up to $5,200. Put a 9% return, 9%, 6%, 6%, 6%. These returns are not whole life returns. That's absolute garbage. If you're invested in a whole life policy, it'll be basically similar to like a 30-year treasury, or it'll be like maybe 3%, 4%, similar to like a cash balance plan, because those tend to often be associated with the 30-year treasury. Granted, the 30-year treasury right now is not 3 or 4%, but historically, at least for the past handful of years, sure, 3, 4%. These numbers are BS. Now, if you had a different type of policy called like an IUL, an indexed universal life insurance policy, Now that could be indexed to like the S&P 500. Okay, and sure, maybe it could have numbers closer to like this. An IUL is, or a VUL, a variable universal life insurance policy, is probably a way better way to go if you're getting permanent life insurance, as opposed to a whole life insurance policy, which really has lower returns. What is one of the nice things about these policies is that because they are considered insurance policies, similar to a cash balance plan, they actually have a principal a capital preservation requirement, to the best of my understanding. So technically, they can't give you a negative return, at least not past like the beginning phase, once you're past the first few years. So it'll be like the worst you could get, it would be like 0%. And so it keeps going up. But of course, that's a trade-off, because when returns are actually higher, they're keeping that high part to make up for the low part. But it does have some similarities to a cash balance pension. Now, I'm going to scroll over to the right. The alternative is, if you just invested in a term life insurance policy and invested the difference in a taxable brokerage account. Okay, so here you put in a $137 premium. So it's like 1/8, 1/9 of the whole life policy. Okay. You invest $1,100. So you're putting $137 into the term life, and all the extra money that would have gone into a whole life policy, you invest into a taxable account. So now you have $1,000 there, or $1,100 there, versus $0 in the whole life policy. Fantastic. The next year you put in another $140. And now your taxable brokerage is up to $2,200. So now you're way ahead. The whole life has only $27. The third year, you put another $140, and now it's worth $3,414 versus $900. So you can see this goes up by over $1,000 every year. Now, if you notice in the header here, it says invested difference in a side fund with a year-end return, at year end with a return of 4.6%. So they are putting in a lower rate of return in your taxable brokerage account than they are giving to the whole life policy. 21%, 12%, 9%, 9%, 6%, 6%, 6%. This is total BS. I don't know how this could possibly occur in real life. Okay. But they do this because these insurance companies, they're going to compare, they'll show this to somebody who doesn't know how to read the numbers. And they're just going to point out, look, if you invest in the whole life policy, you can actually, and what they do here is they stop paying premiums after 16 years because there's enough cash value to basically cover the premiums. So they say you can stop paying the premiums after 16 years. And look what happens. It still keeps growing. So at the end of year 20, you're up to $28,000 in your whole life policy. And that is the same amount you have if you did the other one, but now you're not paying premiums. And this lasts forever. It will never get termed. Like, oh my gosh. But there's no way that this is actually going to hold up, because no returns are going to be like this. And if maybe you're an IUL, then the side pot would probably get at least the same amount as the IUL, right? So these numbers are BS. But the idea, if you look at them independently, yeah, it holds up. If you just made this table yourself and changed the numbers, you could see how much this fails. Now, but people are like, well, why do these people keep selling? Well, of course they're selling because of the commissions. What do they tell people to convince them that it is a good investment? They're like, oh, you've already maxed out your 401k, okay? And you need more tax shelter space. Okay, well, if you really need more tax shelter, you need a cash balance pension, okay? If you want to know anything about cash balance pensions, I have 10 episodes, I believe now, on it that I just did over the past week. So check them all out. But a cash balance pension has a lot of strings attached to it, but it is worth it. Okay, because you are keeping almost all of that money, okay? Here, you are not really keeping all that money, and in a cash balance pension, you get to close that out in like 7 years and roll it all into your IRA or 401k. This is a fixed liability, like for a very long time. You got to keep those payments. If you don't make the payments, kapoof, it disappears. Okay. So what do they tell you? You get tax-free growth. Yes, you get tax-free growth of the cash value, which is subdued. A taxable account is super tax efficient, especially if you invest in low turnover funds, okay, like index funds, for example, or a well tax managed, actively managed fund can be super tax efficient because they're holding on to assets. They're not trading in and out, generating a bunch of capital gains. And those dividends are more likely to be long-term as opposed to, qualified rather than non-qualified dividends. Okay. You can tax loss harvest in a taxable brokerage account. I just talked about that, I think just yesterday in episode 79. You don't have to pay much tax on a taxable brokerage account. We donate our appreciated shares to our donor advised fund so we don't pay capital gains tax. We tax loss harvest our losses so we don't have to pay capital gains tax. And it saves us money on tax. Okay, the best benefit for any high income person at a high tax bracket is to always take anything pre-tax. That is where the money is. Okay, tax-free growth is very much less attractive than having something pre-tax with tax-free growth. Okay, now you get tax-free growth in here, then later on you can pass it to your beneficiaries and they say, your beneficiaries can receive this tax-free. Whoop-de-doo. The same thing with a taxable brokerage account. You get a step up in basis and they don't pay capital gains tax on it. No tax. This is all within your estate tax limits. Okay, and the same goes for this. Now, there's a little exception here. If you are hitting the estate tax limits, which is like over $20 million right now for a couple, granted it used to be smaller and it can always change, and who knows what it'll be in the year you die. There is actually a benefit of having life insurance inside of an irrevocable trust, as far as I understand, because that irrevocable trust, those assets don't necessarily count toward your estate. So what some people will do is they will put a whole life policy owned by an irrevocable trust. I have a life insurance policy that is going into place owned by the irrevocable trust. So it will be inside the irrevocable trust. And so that is one of the ways to kind of expand your estate tax limit by putting some of your assets over to the irrevocable, which you could do with a life insurance policy. Okay. But for people who are within their estate tax limits, then it doesn't matter. Taxable brokerage or whole life policy, whatever, that all goes tax-free to the beneficiaries. Okay. So when they're trying to sell that, that's also BS. Okay. Now, then you have these people who talk about infinite banking. Okay. Wow. That is like a super sexy term. Infinite banking. Bank on yourself. Be your own bank. You know how to be your own bank? You have money. And then when you need the money, you use the money. That's how you be your own bank. Now, people will talk about in this infinite banking space, they talk about, well, you can take a loan from your policy and use that loan money to make more money. So you're going to loan from your policy. Okay, now remember, you're the one who put the money into the policy. And part of it went to pay for insurance, and part of it went to pay for fees, and another part went into your cash value. Now, you're not going to have any cash value for the first couple of years. And so you get to year 3 or so, and now you have some cash value there. Well, you can't just take that cash, because if you just cashed it out, you'd have to surrender your policy. But you can use it as collateral. You can use it as collateral and take a loan from the company. So you're taking a loan from the company using your own cash value as collateral. So let's pretend my cash value is up to $50,000. Well, they will allow me to borrow, let's say $40,000, so like 80% of my cash value. Okay, maybe 90%, so like 45,000. Okay, so I'm going to take a loan of, let's say, $40,000. My cash value is $50,000. It's in a whole life policy, and the whole life policy is earning, let's say they tell you is going to earn 3% per year. Okay. Now, when you take this loan, you are not taking the money out of the account. They'll say, but your money doesn't actually come out. So your money is still earning more money. Okay, so yeah, your money will be earning 3%, but you borrowed money and they're not going to let you borrow at 3%. They're going to have you borrow at 6%. Okay, so like any other loan, often you're like 6% with collateral, so 6% loan. And now you can take that money, $40,000, and invest it in something else that makes 10%. You could do private money lending. Okay, but it's just a loan to you. So if you're making 10% private money lending and then you pay tax on it, now you're down to like 6%, and then you have to pay interest, you're washed out. But if you were to make 15%, then, oh wow, then you're actually coming out ahead. But all you're doing is leveraging. You're just taking a loan and trying to make more money on the loan. And you're using your own money as collateral. You know how else you can use your own money as collateral? You don't need a whole life policy to do this. You can have it in a brokerage account, and some brokerage accounts will allow you to borrow as a line of credit using your brokerage account balance as collateral, like 50% of the balance. So for example, let's say you have $1 million in your brokerage, they would give you a line of credit of $500,000 that you can borrow at 6%, and you can pay it at any time. And often these lines of credit that are backed by your own money, whether it's cash value or your own brokerage assets, they don't actually count as a loan that get reported to credit agencies because it's secured by your own funds that they have access to. Okay, so that is one of the nice things, is that you don't have to really report this loan, but you can do the same thing in a taxable brokerage. Now you can't do that at Vanguard or Fidelity, from what I know. Maybe you can. I'm pretty sure you can't on a regular brokerage account, but maybe if you have like a managed account with Fidelity or with something like that, then they might allow you to borrow, but not with the regular services. But there are other ways. And then there's just, hey, if you have that side pot in your brokerage account, instead of taking a loan from it, just use the money to invest. Okay, you don't have to borrow money to invest borrowed money when you have money. All right, so that's how people sell you on this whole infinite banking thing. You're just going to borrow from your cash value, which is just your own money that you gave them and they put to the side because you didn't invest in a term policy and invested on your own in the side. You can't really make money out of nothing, right? It always has to come out of somewhere. Now, if you are able to borrow from like your whole life policy amount, like let's say I bought $1 million policy and I'm paying $10,000 a month premiums. Okay, that's a lot. I don't know, $10,000 a year premiums, and then I could borrow like $500,000. That would be amazing. But you're only borrowing from your cash value. And if the balance that you have, so it accrues 6%, you don't actually have to pay that interest because it's still secured. But if your balance of your loan exceeds the cash value of your policy at any time, poof, you just violated the policy, and the policy goes corrupt, and it basically closes down. And I think they make you pay tax on all of the tax-free growth you had. Like, it's a disaster. So you never want to get to that point. You want to take 80% out. You don't want to go over like 90 to 95% of the balance. You can just pay the interest every month to make sure it doesn't grow, but they'll tell you don't have to pay the interest. And the interest grows faster potentially than your cash value does because they grow at different interest rates. Now, I will give you one big exception. Okay, so first of all, there was one partial exception with like an IUL or a VUL. They're not nearly as bad. There are definitely people who have a benefit of having a permanent life policy, people who have super illiquid assets and are going to pay estate tax and you need like $1 million in cash when you die, but you can't get it because all of your assets are illiquid, well, that's a great reason to have a whole life policy. But the exception I was actually getting to is if your policy is owned by your business. If you have a business that gets a IUL, VUL, maybe a whole life policy, but it's a business policy that can be an expense to the business as a benefit for the employees. And if you own your own business and it's just you're the only person, then you can take your premiums as a tax deduction. Now that can be very attractive because if you put in an IUL and let's say it gets 6%, and there's going to be fees. You're going to be paying a bunch of commissions the first 2 years, but that's all pre-tax. You're taking a 40% tax deduction. That is awesome. And if you're doing it pre-tax and you get a tax arbitrage where you're paying pre-tax 40% now and then like 40% and you're paying like 25% later, then that tax arbitrage can well be worth it. All right, I got to get out of here. This is not for your financial, legal, accounting advice. My entertainment may be yours. Until tomorrow for episode number 81. Don't buy a whole life policy.